Hello, everyone, and welcome back to Accounting with Oscar. We are finally back again after I don't know how many months it's been. My apologies, I know it's been a while since we've uploaded some new content into this channel, and I do apologize for not being that active and not replying to all of the comments as I hope I would have. Well, just on a personal note, I've been in and out of the hospital for health reasons. Been in and out of the hospital twice for 2 months, in fact. So when I was discharged, there was a lot of backlog I had to catch up with. So it took out most of my time and drained out most of my energy. Well, anyhow, we're back again today for a quick video. Now, today's video, I know a lot of you have been requesting not to go through a full past years. I did gather some topics in particular which you would want me to explain. So we're going to try to cover that in this video that we have today. Now, also, I'll be uploading a separate video where I'll be going through some Q&A because I did ask y'all to leave some questions, whether it was on YouTube, Facebook, or, other social media, even just my students IRL, right? So I've gathered your questions. I'm going to try to answer them in another video, but for today, I'm just going to cover some topics, to get you ready for the October-November sitting. I don't think I'll be able to do a past year paper anytime soon. I really apologize for that. I'm struggling right now with a ton of workload, but I'll try my best, all right? No promises. But anyhow, today I'll be visiting a few topics most of you have commonly requested. So let's talk about the first topic, and I think this is something that a lot of my students have been requesting for. Even those of you from YouTube, you've requested for this. Let's talk about depreciation. Now, depreciation, it is not a difficult topic to conquer. In fact, if you understand the concept or you understand the logic of depreciation, you actually find it to be quite an interesting topic. In fact, it's going to be fun. I find it fun. Well, I mean, I have that joke, so yeah, anything's fun for me. But okay, let's talk about depreciation, right? A lot of people struggle with depreciation because they don't understand what it is and they don't know what the hell they're doing. So mainly people are just following double entries and, trying to memorize stuff. But let's put this in a way that you will understand. Now, depreciation, if you break down the word, depreciation comes from the word depreciate. And depreciate, as we all know, is the opposite of appreciate, right? So when you appreciate something, you love something, you appreciate it very much, what happens is the value of that item goes up, right? So you appreciate your children, you appreciate appreciate the silence of nature, you appreciate maybe the silence of the night, being able to light up some candles and wash your toilet in the middle of the night. Yeah, you appreciate, right? So the value goes up. Now, depreciation is where the value of something reduces, the value falls. Now, what are we talking about? We are speaking in the context of non-current assets. So depreciation specifically, right? We are looking into the concept of non-current assets, the aspect, sorry. So when you talk about non-current assets, such as maybe I give you a vehicle, right? Let's give you a vehicle. I'm not very good at drawing, but I did get an A for art. So here we have our little vehicle here. Now this vehicle, when we bought it new, the cost was say about $150,000. Now this was when it was new. when you start driving this car right out of the garage, what happens is the value falls automatically, right? You put it out into the open air, you just drive it to work to and fro every day. Time passes by, you get a bit of wear and tear, your interior starts falling a little bit apart, the exterior starts getting scratches. So what happens is you use up the asset. You're using the asset, right? So when you use up the asset, naturally the value of the asset will fall. So when you come to the year 2026, the vehicle that you bought for 150,000 may only be worth 120. Now that is what you call depreciation. So you are reflecting the fall in the value of an asset, right? It's the fall in the value of an asset. So this applies to almost all non-current assets, right? Whether it's a machine or whether it's some office equipment, furniture, it all works the same, right? Whatever asset that you have, the more you use it, the lower its value is going to be because you are consuming, right? We assume you are using up part of the asset. Now, then comes the question, right? How do we go about this depreciation? So now we know depreciation is a fall in value, but how do you go about it? Very simple. There's actually three methods that we use to calculate the value of depreciation. Well, two if you're looking into the ACCA syllabus, three if you're looking under IGCSE syllabus, and there's going to be four if you're looking into other syllabus, right? So this is a generic video, right? Now, if you follow the ACCA syllabus, those of you who are doing the FIA paper, you know that we have straight line method and also the reducing balance method. Now, these two are the most common method of depreciation. When you study IGCSE, you're going to learn a third method, which they call the revaluation method. A very simple one, in fact. And in case any of you are doing any other diplomas or degree, you have this method called sum of digit method. Now, to keep this video short and simple, I'll not be discussing the sum of digit method because that will take a while to explain it. I'm sure those of you who've tried this, you have your headaches, right? So keep it simple. I'm going to talk about the top three that we usually deal with. So we have the straight line method, which is arguably a simple method of depreciation. So under the straight line method of depreciation, what we assume is a constant depreciation every year. So every year you are going to depreciate an asset by the same amount. Or to phrase it in a simple manner, you are using the same amount of an asset every year. So this straight line method, it applies to assets to which you get equal benefits every year. For example, let's talk about a property, right? So you have your little factory here. So this is your factory in the middle of nowhere land. Now, this factory that you have, is it going to give you an equal benefit every year? Most likely so, right? So this factory could have been valued at, say, 500,000 and is gonna last you for a long time. It might last you for, say, about 50 years, right? So that means every year we assume that you are consuming $10,000 worth of this factory because it serves you an equal benefit every year. You don't get higher benefits in the earlier stages or in the later stages. It's gonna be equal every single year. So when we face this type of scenario, we go for the straight line method. Now, as you can see here, my formula is to take the cost of the asset divided by its useful life. Now, this is a simple formula if you only have two information. Now, certain scenarios, you are given what they call a residual value. This residual value is the balance, or is a balance, right? Is a presumed value that you are going to get when you sell the asset at the end of its useful life. So let's say after 50 years, you believe you can still sell the factory and you can get back about 150,000. Now, this is what you call a residual value. Residual value is aka the expected resale value at the end of the asset's useful life. Now, this is something that we presume we are going to get back. So it's something more of like a guarantee that we'll be able to get this back. So we don't depreciate the residual value, we take it out from cost. So cost minus residual value divided by useful life. That is your formula for straight line depreciation. Of course, certain questions, they'll give you a percentage that makes your life even easier. So you just need to use the cost of the asset multiplied by the rate of depreciation. And there you go, straight line method done. Moving on, let's talk about the second method of depreciation. Now, this method is a method that either you love it or you hate it. Some people think it's easy to work about. Some people find it a bit complicated. Well, I stand in the middle, right? We talk about the reducing balance method. This reducing balance method of depreciation carries a meaning behind it. What do you mean by reducing balance? So reducing balance means that depreciation will reduce every year. Okay, that is the understanding behind reducing balance. Depreciation will reduce every year. Now, this method is very suitable for assets. Okay, is very suitable for assets which give greater benefits in the early years. Now, let's give you a simple example and you would understand. Now, let's say iPhone 17 just launched, right? Yeah, anyone got a new iPhone 17? I didn't. Okay, well, don't get paid enough to get one. But I don't find the necessity for one. But anyhow, yeah, let's talk about iPhones, right? So you see, when Apple launched the new iPhone 17, how much was it priced at? Okay, I don't know what's the value in your country. Let's just say it's about 1,000. Okay, let's just say this mobile phone, right? This little piece of evil that's controlling your life today is worth $1,000 when new. Okay, now you bought this year, a new iPhone 17 Pro Max for $1,000. Now, what happens to this phone is that you are going to use it and you're gonna love it, right? When you first buy this phone and you first use it, you're gonna love it. You're gonna be like, oh, there's so many features. I didn't know you have this. I didn't know you have that. Wow, this is something new. You know, we're gonna play with this, play with that, try to mingle around, right? So when you buy something new, okay, in the first year, second year, it gives you more value. You get more benefit out of it. Now, fast forward Fast forward to the year 2035, 10 years later. What happens to the same phone that you got? It's gonna start slowing down, it's going to be very laggy, right? Your battery is dying, certain parts are, dead, maybe your screen is cracked to the point of no return. So by then, you are going to get very, very little benefit from the same asset. Probably you only use about no $200, maybe not even $220 worth of it. So in 2025, 2026, maybe you use up like, here you would have used about $100. You go to the later years, 34, 35, maybe you only use up like 20, is only worth that much to you. Or let's talk about a new computer. All right, give you another example. You bought a new computer today. Now this new computer is super fast. It runs on some technology that I don't even know about. Okay, now this computer, when you bought it this year, the price was about 5,000. Now this year you started using it, so it gives you a lot of benefit. It gives you a lot of benefit. Oh, you can work so much faster. The thing runs faster. So this year you use up, say, $300 worth of this asset. Then slowly you go into next year. Okay, still quite a new computer, still very smooth. Everything runs well. Maybe you don't use it too much. Maybe about 250, right? But then fast forward there, and then you're gonna come to 2035. Oh, it's old, it's laggy, I can't watch YouTube in full HD. That's what happened to my iMac. After some point, you just can't watch YouTube in full HD. Well, not that I'm gonna complain, but yeah, after 10 years, maybe you only use about $20 worth of it every year. Yeah, imagine, you buy an iMac in the year 2009 and fast forward it's 2025. You can't even watch YouTube in full HD. Do you know that? So that's my suffer. Well, but you get my point, right? So you understand why it's called reducing balance. Now, for reducing balance, your calculation is not gonna be as straightforward, because for the calculation of reducing balance, they usually take the net book value, or some of you call it the carrying value of the asset, multiplied by the rate of depreciation. You don't take the cost. We always use the latest figure, right? Latest figure, how much we are using of that figure. Now, the formula here to calculate net book value or carrying value is to use the cost of the asset minus the total provision for depreciation. You'll find your net book value multiplied by the rate, and there goes your depreciation. Simple example, cost of asset when new, 7,000. Rate of depreciation, 10%, using reducing balance. I'll give you a very simple example. So in year 1, this asset will be depreciated as per normal using the original cost of 7,000, because we have no book value, right? So it's worth, that means you used up $700 of the asset, and it's only worth 6,300 today. Now, year 2, you continue using the asset, assume another 10% is used. So today, depreciation sits at 630, which means at the beginning of year 3, the same asset is only worth 5,670. Use up 10% again, that's going to be 567. So you go into year 4. This asset is now worth 5,103, and you continue doing the same thing every year. So you're not using the You're not using the cost, you're using the net book value, the current value of the asset. So that's the straight line method and the reducing balance method. But of course, some of you find this alright, some of you don't. Some of you suffer in other areas as well. Yep, so let's talk about prorating depreciation. You see, there are two main methods we use for depreciation, but there's also two different policies. I call them policies, okay? Two different policies you can apply to depreciation. Some questions, they will require you to calculate depreciation based on months, right? Depreciate by months. In other words, you need to do a prorata. Some questions, they will allow for a full year's depreciation in the year of purchase. Now, you just have to be careful with the terms that they're using to fully understand which policy you're going to apply. If you're going to depreciate by months, right, don't feel shy, use your fingers, okay? Use your fingers, not in the wrong way, use your fingers to calculate, okay, the number of months you own the asset. For example, if your financial year end is 31st December and you bought an asset, okay, you bought an asset on 1st of March, okay, you bought an asset on 1st of March. Now, from 1st of March all the way to 31st December, right, how many months are you going to depreciate if I want to do a prorata? So I'll have March, April, May, June, July, August, September, October, November, December, right? So that's about 10 months that we are depreciating. So when you calculate your depreciation, cost multiplied with the rate, you need to do a prorata of 10 over 12. Easy as that. Easy as that. All right. That is if you do a prorata. If it's a full year, even easier. You don't need to do anything. Just depreciate as per normal. So that is our first topic covered on depreciation. So following depreciation, another heavily requested topic was disposal. Okay, so let's talk a little bit about disposal. Disposal happens when you realize you don't need an asset in your life anymore. So you have 3 machines, you figure out, hey, screw it, I only need 2, okay? So what I'm gonna do, I'm gonna sell off one of my machines. Now, that's a disposal. When you get rid of your asset, that is a disposal. Now, there are 3 different scenarios to disposal, right? The first scenario is you sell the asset for cash. Sell it, get some money out of it. Number 2 is what they call a trade-in or a part exchange, where you sell your asset in exchange for another new asset. Or the third scenario, if you're unlucky, okay, sometimes your assets get destroyed. You know, aliens invade and you lose your machines, you know, out of everything, they just decide to ruin your machines. Yeah, things get destroyed. So when things get destroyed, what we do is we send them over for scrap, you know, scrap metal. So you're gonna see that lovely R32 go through the conveyor belt and they're just gonna like destroy it into like pieces of metal. So there are 3 scenarios under disposal. Well, 3 that I can think of. If you can think of any more, up to you, right? Now, either way, disposal refers to getting rid of your asset. So, what we focus on with disposal is more of a double entry, right? Understanding, I'm sure you get it. So I'll talk a bit about the double entry. Now, double entries for disposal I have my few steps to work with. You can adopt this if you want. Step 1 is what I call remove the asset. When you sell an asset, it no longer exists, right? So what we need to do is to get rid of the asset. I will credit the non-current asset account, and my corresponding entry will be parked to disposal, right? Only for disposal purposes, all corresponding entries will go to the disposal account. Now, once you remove the existence of your asset, what you need to do next is to remove the accumulated depreciation, or what they call the provision for depreciation. So you already sold the asset. Any fall in value is no longer valid. So what are we going to do? We are going to do the opposite, right? You're going to debit the provision for depreciation account, do the opposite, credit to disposal. Yeah, in fact, I just realized I didn't give you the double entry for depreciation. I'm sure you have it in your heads. Double entry for depreciation is to debit depreciation because it is an expense. You are consuming an asset. It's an expense. Debit depreciation, credit provision for depreciation. This provision for depreciation is a reduction to asset value. Asset is on the debit, so when you reduce its value, you come to the credit side. Right, so that's the double entry. And also one thing I forgot to talk about was the accounting principle. Now, if you are looking at depreciation, you typically apply a few accounting principles. Number one, you are applying matching because you are matching your expenses to the year the income is generated. Number two, you are applying prudence by not overstating the value of your non-current asset. And what else are you applying? Matching, prudence. Well, you can argue a bit on going concern as well, right? You can argue because we depreciate assets when we expect, to continue using them. If you're gonna like close the business, you just put everything on the breakup basis, right? So it's arguable, right? Depends on how you debate. Anyhow, coming back to disposal, first you gotta remove the existence of the asset from your life. Once you remove that, any fall in value should also be removed. Now, once you do that, I come to step 3. Step 3 is where I will record my sales proceeds. I sell the asset, I get money, right? So debit bank account, credit the disposal account. And there you go. That's your 3 steps for a normal disposal, which you sell for cash. That's probably what you need to know, right? Understanding, definitely you have it. So just you gotta understand the double entry. First, remove the asset by crediting the asset out of your ledger. Number 2, remove the accumulated depreciation by debiting the provision for depreciation account. Number 3, record the money you received. So this applies to scenario 1, selling an asset for cash. Now, in the case you are doing a trade-in or part exchange, what you will do is instead of recording the sales proceeds, you are going to record the trade-in value, how much you are getting for the old asset in return for a new asset. You know how trade-in works, right? Today I have this, let's say we have a very, very old car, okay? This is probably a Shelby. I know it doesn't look like a Shelby. Okay, let's say we have a Shelby here. probably a 67 or 68, maybe a 69 Shelby, right? So we have this very, very old car. It was from 1969. What I want to do is I want to get a new car. I want to get a new car. I want to get a TVR. So I want to get a TVR, right? This could cost me about a good, maybe a hefty like 300,000. Okay, so what I do is I tell the dealership, hey, I have an old car, I have an old Shelby, right? Can you take it in? Right? That means I'm giving you my old car to get a new car. Now, these people at the dealership, they're gonna start valuing my car, They're gonna start valuing this old car here. Probably they say, yeah, we can give you some credit, I'll pay you 10,000 for it. So here, I'm buying a new car for 300,000. What they're gonna do is they're gonna take 10,000 off my bill, right, in return for my old car. So I'm giving them an old car and I'm getting back a new car. Now, this old car is gonna save me some money on the new one that I buy. So when there's a part exchange, we record the trade-in value. So instead of receiving money, we are getting a new asset. I will debit new non-current asset, credit disposal. This is my step 3 if I am doing a part exchange. And additionally, there'll be a step 4 if you do a part exchange, because not every asset can cover the cost of a new asset. Like my case, right, I'm only getting 10,000 back for my old car. I still have to pay 290,000. So that's where double entry number 4 comes in, right? Pay money out of the bank to acquire the asset. Now, that is the part of disposal. If it's scrapped, then same thing. You do step 1, step 2, but you don't receive any money. So there's no step 3. Now, one of the important areas under disposal is calculating what we call the gain or loss on disposal, right? If I sell off an asset, of course, I will want to know whether I'm making some money out of it. It's not your main business. You don't buy and sell assets all the time. But if we do, we are human beings, we are curious, we're curious little gnomes, We want to know how much we earn. So to calculate the gain or loss on disposal, you're going to park everything, right? Park all these double entries, and you're going to balance up the disposal account to find the gain or loss. Or a faster way of doing it is to compare the sales proceeds of the sales proceeds you're getting versus the net book value of your asset. If your sales proceeds, if you're getting back 10,000 for something that is worth 9,000, you are making a gain, right? That means you are earning money. That's good. You get 10,000 for something worth 9,000. That is a gain on disposal, right? When sales proceeds exceeds your book value. Now, if it's the other way around, if your sales proceeds end up being less than the book value, that means you're getting only 9,000 for something that's worth 10,000, you are making a loss on disposal. So a loss on disposal is what we classify as an expense in our statement of profit or loss. If it's a gain, we'll park it as an other income, right? So that's the explanation on disposal. All right, now let's bring you all on to the next topic. I'm trying to cover all this in one video. Let's hope we can make it. Okay, the next topic, very, very, very commonly asked, very commonly requested, is the topic of errors. Yes, errors are a killer to most people, but just a disclaimer, there's nothing much I can talk about for errors because different errors, they require different adjustments. But okay, let's talk about correcting errors because theoretical elements, I'm sure you can read up on them. Yeah, different types of errors that affect your trial balance and don't affect your trial balance. I think you can read up on that. I can do another video of it if you want, but it'll just be pure theoretical, right? So I'm going to talk more about how to resolve errors. Errors, they exist, right? And we can't leave them there. You can't have errors hanging. End of the day, we have to resolve the errors that we see. Now, what I like to do with correction of errors is I always use a 3-column method whereby I have the correct double entry, the wrong double entry, and the correction entry. So this helps my mind to process a bit better. Give an example. Let's say I have a transaction which is a cash sales of $400. Now, what I did was I debited the sales account and credited the cash account. So I parked 400 here and I parked 40 here, right? Let's say cash sales, and this was the double entry I made. Obviously it's wrong, right? So I have my column for the wrong entry, and I will then park the correct entry here. So cash sales, your double entry is supposed to be debit cash, credit sales, right? 400. Now, what I'm going to do is I'm going to make my correction in this column. And I'm going to do it in 2 steps. First one, I will reverse the wrong entry. Now, second step, I'm going to record the correct entry. So if you do something wrong, apologize to the person, ask for forgiveness, and then do the right thing. Right? It's the same principle we apply here. That's why accounting is very, very lifeful. You apply the same thing to life as well. So anyhow, the correction. First, I need to reverse the wrong entry. The wrong entry is a lot, right? Debit to sales is a wrong entry. I need to reverse that. So to reverse the debit, I need to use a credit. Credit my sales by 400, and I need to debit the cash account by 40, right? So that's the first step. Reverse the wrong entry, put everything back to neutral. After that, I'm going to record the correct entry, which is to debit cash by 400 and credit sales by 400. Right? So all in all, if you look into it, we are going to debit the cash account by a total of 440, right? And we credit the sales account by 800. Does it balance? No, because the first correction entry has an issue. It doesn't balance. Double entry must tally. Whether it's in correction of error or not, it has to tally. So right here, there's going to be another account to be opened, and that is called the suspense account. I know some of you asked for this as well. So the suspense account is a temporary account which you are going to use to balance up transactions. It will not appear in the final accounts. It's only temporary. So you use a suspense account when the debit and credits do not balance. Like the first correction, for example, right? It doesn't balance up. There's still a remaining difference of 360, and you're going to park that into a suspense account, right? You definitely need this because Originally, your entry was not even tallied. It was a debit of 400 and a credit of 40. Definitely it's not going to balance up. So all in all, if you summarize the double entry, we debited cash 440, debited suspense 360, credited sales by 800. So that is our correction of error, right? There's not a lot I can talk about because it varies based on different errors, but the main principle is the same. Figure out what is the correct entry, right? Write out what they did wrong, and from there, observe what is the correction. To perform a correction, say sorry, move on, do the right thing, right? Reverse the wrong entry, record the correct entry. So that is correction of errors, just a short one. Now, coming into yet another topic you want me to discuss, and that is the accruals and prepayments chapter. Okay, accruals and prepayment. Yep, I know. To some people, it's lovely. To others, it's pure pain in the ass, right? I know. When you deal with accruals and prepayments, it's crucial that, first of all, you know what the hell you're doing. So for me, under accruals and prepayment, I'll always have my little table right here. So this will help me to explain things a little bit better. So we have two items. We have accruals and we have prepayments. Now, accruals, they are items which are not paid for, right? Things that have not been paid for. Prepaids or prepayments, in fact, these are items that, they are paid in advance. So you haven't used it up, but we paid in advance first. Now, what people always overlook and what people always forget is that there are actually two point of views to accruals and prepayments. There are 2 point of views, right? And a lot of people, they overlook this. We have accrued expenses as well as accrued income. Do you see that? So we have accrued expenses, at the same time we have accrued income. So if I'm talking about accrued expenses, right? Accrued expenses, these are expenses which we have incurred, but we have not paid for them. You used it, but you have not paid. In our accounts, we take this in as a current liability. But if you're looking at accrued income is income which you already earned. You earned this income, but you have not been paid. So in other words, this is reflecting a current asset. Now, the same applies to prepayments. Look at it from two different point of views. A prepaid expense is something that you have not incurred, but you paid in advance. So this person owes you the money or the so-called service, therefore rendering it as a current asset. But if this is a prepaid income, it's going to be something that you have not earned, but you receive it in advance. You have not earned, but you received it. Now, this is when it turns around to become a liability, because you owe the other person. You owe them the money or the so-called service, or items. So you owe the person. It becomes a liability. Right, so first you need to set things straight. You need to know where are you, right? Where do you belong? Are you in the category of expense or income, right? That will determine whether it's an asset or liability. Now, another thing to note with accruals and prepayment is to be extra careful when you're looking at the dates, right? When you work with the dates, you gotta be careful. You need to know when is your cutoff. When is your financial year end? This is crucial. Now, if you know your financial year end, for example, 31st October, right? If you know this is your year end, and I tell you that on 15th of September, we paid $3,200 for electricity. Okay, for the 3 months or for the 4 months ending 29 February 26. Okay, let's say, is there even a leap year in 26? I don't even know. It happens one every 4 years, right? No, it's 28. Okay, sorry, people born on 29. Yep. So let's say, right, your financial year end is 31st October. 15 September, you paid 3,002 for electricity. For the 4 months ending 28 February. Now, you know your year end is 31st October. So when you pay something all the way up to 28 February, you would know this is a prepayment. But of course, by how many months, right? And whether it's an asset or expense, you need to read the keywords, read in between, right? So 15 September, you paid for the 4 months ending 28 February. So you're paying for February, January, December, November. So the complete amount, the whole amount of 3,002 then becomes a prepayment, right? Because your year end is on October. But if I change this up, if I put this to 31st December, then the scenario will change. So you're paying for December, November, October, September. Then you have to prorate it. So 3,002 is for 4 months, right? Now, 2 of the months relate to this financial year. So you gotta multiply by 2 out of 4. So 1,006 will go into your income statement, whereas the remaining balance, right, the remaining 1,006 will enter the financial position as a current asset. So that's the probably one important point you need to take note. When is your financial year end? And be very, very meticulous, right? When are they paying up to? Or what is the period they are paying for? From there, if the period falls inside or before your financial year end, it will be posted to the income statement because it relates to the current year, is related to this year. Any figures that fall outside of the financial year end, that will be either an accrual, it has to be a prepayment, right? You pay in advance. So if it's out of your financial year end, it will be a prepayment. Bring it to the statement of financial position. So that's probably one thing I can advise you on. And okay, one more topic that I want to discuss about, and is also another popular topic requested by most of you, and something my students IRLs struggle with as well. So we talk about control accounts, right? Let's talk about control accounts. Anyone struggling with this? So control accounts, right? What we understand is these accounts are a totals, right? Is a totals account. So the control account serves a purpose to control the figures. Control the figures of receivables and also payables. From your basic understanding of accounting, we have a total of 3 ledgers within the accounting system, right? We have the general ledger where you see almost everything. You have something called the sales ledger. So the sales ledger is where you find individual customers' account. And there's a third ledger known as the purchases ledger, where you see individual supplier accounts. Now, end of the day, what we want to do or what we aim to do with control accounts is to make sure that the total of the sales ledger tallies with the control account in the general ledger. Same goes here. I want to make sure end of the day, the total of the purchases ledger tally up with the balance of the control accounts in the general ledger, right? Now, if you don't know what the hell I'm talking about, let me give you a very short and simple scenario. We are going to record a little bit of sales into our day book. 1st of October, I sold to I issued 3 invoices today. I sold to 3 customers. Sold to A, B, and C for $100, $200, and $300. Now, all in all, my total revenue for the day is 600. This figure of 600, it's going to be posted into different sets of ledgers. Now, inside the general ledger, I will bring the totals over. So when I come to this sales ledger control, I'll bring the entire total of 600 over to this account. Now, this is the control account inside the general ledger. Of course, I will have individual customers account in my sales ledger as well. So we open one account for each customer, and we will post their individual transactions into their related accounts. So A gets 100, B gets 200, C gets 300. Now, end of the day, the aim with control accounts is we're trying to make sure that the total of the individual accounts tallies back to the total of your control accounts, right? So that's the purpose why we have control accounts. It basically acts as a reconciliation purpose. So to reconcile the total of individual customers in the sales ledger to the control account balance. That's number 1, right? As a reconciliation. Number 2, it serves to provide an instant total, okay, to be included for receivables in the financial position. Okay, so having understood control accounts, let's dive into the actual control account itself. Right, so as you know, we have 2 control accounts to deal with. I'll start with the first one, which is the sales ledger control account. Now, how I work around control accounts is the same way how I work around every other ledger. Identify what it's related to. Sales ledger control. Now, the word sales here is associated with receivables. Receivables, I sell to them. They owe me money, right? Receivables, they owe me money. So in my point of view, these are my assets. I have the rights to collect money from them. Now, assets are recorded on the debit side. So any entry in the debit side would increase the receivables, while any entry to the credit side reduces it. So here we are talking about certain things like sales, right? Receivables, you sell on credit to them. So sales will appear on the debit side. Debit receivables, credit sales increases the amount that they owe you. Now, what else will appear on the debit side? You are going to see interest charged. Certain customers, they go beyond their period, right? You give them 30 days, they take 60, they take 90. So what we do is to avoid irrecoverable debts, we will charge them an interest, and this will increase the amount that the customer owes you. Other than this, we also have cases of dishonored check, where the customer pays you a check but for some reason it was rejected by the bank. Now, if a customer's check gets rejected by the bank, we don't just let it go, you know. You're gonna chase after the customer like hell. You're gonna ask them to pay you back. So you increase the amount that they owe you back to the original amount because the check was rejected. So that's about 3 things there. On the credit side, you will have the bank, right? When the customers make payment, it reduces the balance they owe you. Now, certain times, if they do pay you early, we give them a discount. So again, this reduces the receivables amount. Other than that, we also have returns, right? So we call it a sales return or a return inwards. So sales returns or return inwards, again, they reduce the amount that the customer owes you. Now, besides this, we also have something called bad debts. Customers who owe you money, all of a sudden, you know, number of dial is unavailable, they run away, you can't chase them, they're probably hiding somewhere together with Joe Lau. You know, the guy who diverted lots of funds and assets from Malaysia. Yeah, probably he's with them, you know. I mean, he's with him, right? So bad debts, they owe you money, they can't pay up, they run away. Just like the missing planes, you know, they just disappear. So yeah, that's the part on bad debts. Okay, now one more thing that we're gonna park in here will be contra entries between the receivables and payables. Now let's talk about how contra works. Contra is a scenario where I am your customer and also your supplier. So I owe you, say, 700, and you owe me a billion. No, I'm kidding, okay? I owe you 700, you owe me 500. Now, going by a very traditional way, I can pay you 700, you can pay me 500. That will be 2 transactions. Or what I can do is I apply a contra. I owe you 700, you owe me 500. Let's net this off. When we do a contra, we net it off. So once I net everything off, I will only owe you 200. You don't owe me anything. You don't need to pay me, and I will just revert 200 to you. So that is our contra. Contra will reduce both the receivables and payables at the same time. Therefore, its double entry is to debit the payables and credit the receivables. right? So that is our sales ledger control. Now let's talk about the next control account, which is the purchases ledger control. So you have the sales ledger control, you will have the purchases ledger control. So it works the same way. I will associate purchases with the payables. I buy from my supplier, so the payables, right? I owe them money. I owe them money, this will be reflected as a liability. Liabilities are recorded on the credit, so any increase will appear here on the credit side. Any reduction to the payables will appear on the debit. Now the items are similar to the sales ledger control, only thing is they'll appear in the opposite sides. So to increase the purchases ledger control, you will have purchase transactions and of course interest being charged to you, right? This will increase the purchases control. On the debit side, for reduction, you will have bank when you make payment to the suppliers. Sometimes suppliers, they give you a discount. So discount received, right, will reduce the amount you owe to them. Sometimes we make a return to the supplier. So there'll be a purchase return, or what they call a return outwards. That appears on the debit side as well. And of course, contra. So these are items that appear under the purchases ledger control, right? Somewhat similar to that of a sales ledger control. So if you follow the arrows, right, your balances, the balance brought down for sales ledger controls should normally be on the debit side to reflect an asset. Now, however, there are rare scenarios where the balance for a sales ledger control could appear on the credit side. It could, right, from an asset become a liability. Now, there's a few reasons for it. Number one, maybe there was an overpayment by customer. They paid you too much, so now you owe them money instead. Or maybe there was a return. Maybe there was a return by customer after account was paid. So they paid you money and they make a return subsequently. So end up you owe them. Now the same could be said for the purchases ledger control. It's a liability. Liabilities are usually on the credit if you follow the arrow. So your balance brought down is supposed to be on the credit. That's a normal balance brought down. But again, you can have a balance brought down on the debit for the same reasons. So you make an overpayment to supplier instead of a liability, becomes an asset, supplier owes you money. Or we made a return to supplier after the account was paid. So for these reasons, it's possible to have a debit balance on your purchases ledger control. Alright, so with that, I think I really need to sum up this video. I'm super tired today. It's been a long day. I slept at about 4:30 the other night. I woke up at about close to 7. I don't have enough sleep, and it's about 9:30 where I am right now. I haven't had my lunch, so yeah, I'm gonna start getting my lunch, and perhaps I'll be getting dinner by midnight. Let's pray. Okay, but yeah, I'm gonna end this video here. I don't want it to be too long. As what I mentioned in the beginning, I'm gonna be doing a separate Q&A video, right? So if you have any questions you wanna ask me, whether it's about accounting or career paths or like study, anything related to studying or study methods, or if you just wanna ask me anything in general, like is Oscar a cat in disguise? Is Oscar actually a cat? Yeah, go ahead, right? That I'm gonna perhaps film that one day when I'm less tired, because I think there are some good questions I have received on Facebook, and also some of it, from students IRL, and I think some of them are good questions. I want to clarify. I want to highlight certain things, but yeah, feel free to ask me anything you want, anything related to my life, or if you're not that interested, just maybe, yeah, tell Oscar to shut up. And yeah, with that, we'll end this video here. I'll see you guys in our next video.